Hey guys, article from Reuters. The dollar dropped to a 3-week low on Tuesday on news of the smallest annual increase in inflation in more than 2 years, cementing expectations that the Federal Reserve will pause interest rate hikes at its 2-day meeting ending Wednesday. The U.S. Consumer Price Index, the CPI, edged up 0.1% last month as gasoline prices fell after increasing 0.4% in April. In the 12 months to May, the CPI climbed 4%, the smallest year-on-year increase since March 2021, after rising 4.9% in April. So-called core CPI increased 0.4% in May. However, the same percentage rise for the third straight month. Moving forward to the FOMC meeting tomorrow, we expect the Federal Open Market Committee, the FOMC, to keep interest rates unchanged, while signaling credible threats that the market participants should not interpret this as the end of the hiking cycle, wrote Tiffany Wilding, managing director and economist at PIMCO. Let's see what happens with that, guys. See what economist Mohammed Al-Erian said on this topic. U.S. CPI and inflation in line with consensus expectations for core and slightly better for headline. With such numbers, it would be very hard for the Fed not to validate the last policy guidance of a, quote, skip, end of quote. That is, keep the door open for a possible July hike, said Al-Erian on Twitter. Always great information from Mr. Al-Erian. Now, let's go to the news live and get more information, guys. Editor, roll clips, fair use.
368 yield on 10s, and the data starting to hit the wire. Rates are moving up already, so somebody seems to have this number before I'm seeing it on the wire services. We're now up to 372, 373, up 0.1% on CPI headline, exactly as expected, up 0.4. If you look at core, stripping out food and energy, that's exactly as expected as well. Year over year, 4%. Year over year, 4%. We're expecting 4.1. Our last look was 4.9. So indeed, this continues that streak. This is the 11th consecutive month since 9.1% in June of last year, which was the highest level since 81. Each successive month has been lower. And if we look at core, which many believe is the most important, 5.3%. 5.3, we're expecting 5.2, so it's 1/10 higher, but it's 2/10 lower than the rearview mirror, which is 5.5. This series peaked in September of last year, Becky, at 6.6. That was a 40-year high. However, we did have the month of March, which moved from 5.5 up to 5.6, so it hasn't been continuous. This is lower. We do see that interest rates have been moving around quite a bit. We're now right back to this 368, 369 level. And if you're looking at intraday 10, we've had a lot of little noise volatility here. But if I had to summarize, as I think the market is now, it's definitely a bit better than expected. These are still sticky numbers year over year, but we are making progress. We see that the pre-opening equities are a bit higher than they were before this number. We're up about 40 points in the pre-opening Dow futures.
2 and 3 years out with the forecast. First of all, I wouldn't put too much weight on forecasts even 1 year out because they're so highly uncertain. But what they're showing is that as inflation comes down in the forecast, if you don't lower interest rates, then real rates are actually going up, right? So just to maintain a real rate, the nominal rate at that point 2 years out, let's say, should come down just to maintain real rates. And actually, you know, since we're probably going to we're having real rates that are going to have to be meaningfully positive and significantly so for us to get inflation down. That probably means that certainly means that it will be appropriate to cut rates at such time as inflation is coming down really significantly. And again, we're talking about a couple years out. I think, as anyone can see, not a single person on the committee wrote down a rate cut this year, nor do I think it is at all likely to be appropriate if you think about it. Inflation has not really moved down. It has not so far reacted much to our existing rate hikes, and so we're going to have to keep at it.
I'll start with you, and I'll start with that Fed meeting on Wednesday and that press conference. Not necessarily a surprise what they did, but were you surprised at what Powell had to say?
So, I actually feel in some ways that Powell got a little bit of the short end of the stick this time around. I've historically been quite critical of the communication that the Fed does. But I think this time around, they paused for a very valid reason. They hadn't guided the market. Well, valid in some people's minds. This Fed doesn't like surprising the market, and it chose not to do so. However, I think they really made it clear that sometimes a pause is really just a pause, and that's what this meeting was. Prior to the meeting, there was a reasonable quantity of people who thought, reasonable portion of the market which believed that the pause was really the end of the hiking cycle. It's not. That's abundantly clear. And I think that we saw action from the Bank of Canada, from the Reserve Bank of Australia. Both in recent weeks have come back. Recent months have come back from pauses. And so I think the market is beginning to be more realistic about what the Fed's outlook is here.
The title of the video, What Happens Next? Like I said at the beginning, you won't believe this, and the market is totally unprepared. Let me tell you what I'm referring to. So I'm sure most of you are sitting back right now and saying, okay, George, I get the deflationary or the deflation data, depression economics, it all makes sense. We could see that in the interest rates. So what you're telling me here, the main takeaway from the video, it really isn't something that would surprise anybody because it seems like rates will go down. In other words, that the Federal Reserve in the next few months or going into 2024 will most likely be lowering rates. They paused, but very unlikely that they go up, so now they'll most likely go down. That isn't shocking to anybody. But here's where the plot takes a twist. It's not that interest rates are going down. It's that interest rates will likely go down and up at the exact same time. It goes back to Milton Friedman, my good buddy right there, and his interest rate fallacy. He said that just because money is cheap doesn't mean that it's loose. In fact, a lot of times when interest rates go low, meaning money is cheap, money is actually very, very tight. Now let's go back to Jeff Snyder's presentation at Rebel Capitalist Live and get the next clip where he illustrates this point even further.
And as demand for safety goes way up, interest rates for risky investments, those go way up. In fact, they go up in a way that's even worse and more insidious. You don't know that they go up. We never track the loans that don't get made. We see the interest rate on government bonds go down, but what is the interest rate for mom and pop's business? It's infinity. We don't notice that. So when you say the interest rate for safety going way down, and at the same time you see prolonged economic stagnation, our star going down, that's not coincidence.
So just like Jeff says, interest rates can be technically low, but for the real economy, for the producers, for the mom and pop business that's out there actually hiring employees, their interest rate can effectively be infinity.
Hey guys, it's Jose, your regular Joe Blow again, keeping an eye out and my ears open to the May CPI numbers just out, excluding, as always, food and energy. Hope this helps, guys, moving forward as we continue to live through these crazy, crazy times. Do your research, and as always, more information and sources are always in the description below. And thank you guys for letting me do my best to bring you the best. Stay free.
It ain't hard to tell. I excel, then prevail.